Welcome to Master Your Retirement with MRS. Melissa Matson has been helping families in Las Vegas plan for a successful retirement. The team at MRS Wealth Advisors will help you learn about strategies for creating income in retirement, managing your wealth, and minimizing taxes. Welcome to Master Your Retirement with MRS.
In life, there are many things you can't control. The good news is there are some things you can control, and that includes how much you'll pay in taxes. On today's show, you'll learn ways to help keep more of your hard-earned money and give less to Uncle Sam. Plus, later in our show, we'll answer some of your biggest retirement questions. And I'm back with Melissa. It's always good to be with you. We're talking taxes. I know you had something you wanted to say before we even get started.
Yes, it's great to be here, Amy. And you know, before we get started, it's really important for everyone to understand we are a registered investment advisory firm. We are not CPAs. It's really great to be able to clarify the roles of those two positions. You know, there are the tax planners and there's the tax preparers. A tax preparer basically is putting the information that happened yesterday onto your tax return. CPAs do an amazing job. We have great relationships with CPAs that we refer you to. We are not in any way giving any tax advice today, but we consider ourselves tax strategists or tax planners, where we can help you stack your income streams in the future to save potential impact of taxes in your retirement. So that's what we're going to be talking about today.
Absolutely. And it all really comes down to control. You know, we all want to have control in our lives. We can't control things like the weather, the traffic jam, the market, things like that. And I think a lot of us really believe that we have no control over taxes when it comes to retirement. But you say that's not necessarily true.
It isn't true, Amy. In fact, it's really important. It's better, of course, if you look at the impact of what it could look like in retirement before you actually retire. But once you enter into retirement, you have so many different streams of income that are going to be landing on your tax return. And you want to know, do I have my buckets of money in the right place? Because, you know, you have your pre-tax money that you've never paid taxes on. Then you have, you know, your taxable money, and then you have your tax-free money. So when you need, when you're taking Social Security, or you are basically using Medicare as your main source for medical care, when you are taking distributions from these different types of accounts, it can make a significant impact on your Social Security. Social Security is taxed at a mere married couple if you make more than $44,000 a year, which is really nothing, hardly. If that's all you're earning, 85% of your Social Security could be taxed. So it's really important to know the back end consequence of where your money is falling on your tax return. Making a plan for that. There's a big difference.
And just as I'm listening to you, I'm thinking this is really going to make up a big part of our retirement expenses when we really start to think about it and all the different factors that are taxable. Is that true? Is it potentially one of our biggest expenses?
Absolutely is. In fact, I mean, 80% of the folks who saved and are entering into retirement right now have saved in that bucket I was talking about, that pre-tax bucket. 80% of their retirement savings is there. So the impact of withdrawing on that stream of income, landing on your tax return, if you need to buy a new car and you need to spend $50,000, that's what the average price of a new car is today. Can you believe that? And that will make an absolute bracket bump or bracket creep when it looks into your standardized deduction. So it's really important that you have some tax efficiency to your portfolio before you enter into retirement, but more importantly, before you hit that age of required minimum distribution age. That is the age that the IRS says you must start withdrawing from those accounts. Tell you what, people get to that age, they've accumulated and accumulated. Why haven't they spent that money? Because they don't want to pay the tax. But guess what?
All of a sudden,
if they're required to take that minimum distribution and they say, but we don't want it. And I said, well, if you don't take it, you're going to pay a 25% penalty and the tax. So, pick your poison. You're going to pay one way or the other.
I think, it all does come down to lifestyle as well. We want to be able to control taxes in retirement and not downgrade the kind of lifestyle that we have hoped for so long, and that maybe we're living in the moment in retirement.
And, that's a great point. If you don't have a plan, so some balance, let's call it balance or tax efficiency in your retirement portfolio, you could have a lifestyle downgrade. We don't want that. We want to make sure that we're able to grab income from different sources, different resources, so that we have that balanced lifestyle throughout our retirement.
Okay, we're off to a great start. This is an important topic. Stick around. We've got much more to talk about when it comes to taxes. The bad news is taxes can be a big expense in retirement. The good news is you have options to help lower your bill. Melissa will explain in depth next.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy, but with someone asking the right questions and helping you learn where you truly stand, it can become easier to work toward your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow, so you can enjoy your retirement today.
Welcome back, everyone. Did you know taxes could be your largest expense in retirement? It catches a lot of retirees by surprise, so if that's the case, you're not alone. There are ways to potentially lower your tax bill, and that's what we're going through with Melissa today on our show. As you and I were saying, even in the break, it's such a big topic. There are so many different directions you could go, and we don't even have enough time here on our show today, but I think I want you to continue to kind of dive a little deeper into those tax saving options, because now is the time also, with the taxes the way they are, to do it. And then we do have options. That's important to point out.
And you know what, Amy, it is one of the largest pieces of the portfolio planning that we really try to go in depth to show people they can take some control of their future. You know, when you talk about tax planning, there's really, just to keep it simple for everybody, there's really 3 types of buckets that our money can fall into. You know, as I said before, you have your pre-tax accounts, you have your taxable accounts, and you have your tax-free, of course, all of our favorite accounts, right? But often when people come in and visit with us, all their money is over here in the pre-tax bucket, because they bought into that in the 80s, that if you contribute to your 401k, your IRA, your 403b, there's actually 37 different acronyms that, basically stand for pre-tax money. 80% of people's retiree accounts is in that bucket. And when we ask them, shouldn't we have some balance between these 3 buckets? They don't really know how to get there. And the money's here because they like the deduction that they got, and they don't want to pay any tax. But pay now, folks, or pay later. You're going to pay taxes on that money. So to bring tax efficiency to your portfolio, in retirement, once you stopped working, your income is lower, and often it makes sense to pay attention to those standardized brackets and convert a bit into the tax-free bucket. pay some taxes a little bit each year, paying attention to those bracket bumps. That way you have a bucket of money that later in life, whether you need to take $50,000 out for a long-term care event, if that were to happen, or if you needed to buy a new car or a new air conditioning, those things are very expensive. If you have to take all that money from a pre-tax bucket, it's going to be considered income. That's going to affect your Medicare IRMA tax. That's going to affect your Social Security tax. All of these different streams of income are going to have a huge impact on your retirement. So bringing that tax efficiency to your portfolio, sitting down with us and going through the different ways, it may or may not make sense. Everybody's situation is different.
You brought up RMDs, required minimum distributions, earlier, and I think it's just important with that topic. You need to pay attention to what's going on in Washington with that one, because the age limit is changing, the penalty changes. There's a lot to really tune into on that one.
Oh, absolutely. In fact, the Secure Act 2.0 that became effective in 2020, it has been amended so many times, and the laws are always changing. So when we ask folks what the required minimum distribution age is, we get all kinds of answers to that question. Some people still think it's 70 and a half, when in actuality, as of today, it's actually 73. And it's going to be changing again in the future. So paying attention to these changes, most of the time people think that deferring their RMDs is going to cost them less in taxes, but in fact, it's probably going to cost them somewhere around a minimum of 25% more. Because with the huge debt, the entitlement programs, there's a lot of tax that needs to be collected to keep our programs intact. So paying attention to these changes is important. And if you don't take your RMDs, guess what? You get penalized.
It's come down, though.
Yeah, it came down 25%, which is nice, but it's 25% plus the tax that you're going to owe. So just take a smidgen more than your required minimum distribution just to keep yourself safe.
Okay, Melissa, one more thing to point out that I think is important. If one of our viewers is working with the financial advisor right now and they're not really having that tax conversation, they're not forward thinking, is it time to get a second opinion?
I encourage people all the time to come in and have a visit. It's just a conversation. Does it make sense for you to bring some tax efficiency from your portfolio by paying taxes now rather than waiting for taxes to go up in the future? Because wouldn't it be nice to have a confidence in your retirement plan, knowing that you've created this efficiency, knowing that you're able to have money for the things that are going to be necessary in retirement, not wondering if Uncle Sam is going to be changing the law, increasing taxes. Nobody wants a what-if retirement. People want a sure thing. So having that balance puts them out of that, I hope I have enough. They have a sure thing that they've done their very best. Life can always happen. Unexpected things can always happen. But we want to do our best to create a very solid strategic plan by addressing all of these issues. And taxes is a huge expense in retirement.
Yeah, hence the acronym MRS, meet, review, strategize, and it's what you do every single day.
And we love it. It's so great.
All right, thank you so much, Melissa. Up next, Melissa takes you through the history of taxes. That's next in Master Plan Minute. Stay with us.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work towards your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
Welcome back to the show. To understand where we're going, it helps to know where we've been. And that's true even when we're talking taxes. Melissa is here to take us through the history of taxes in today's Master Plan Minute. Melissa?
Yeah, a little bit about history of our taxes. Can you believe that taxes have only been around since 1913? Yep, it's true. In 1913, Congress first presented taxes and they were at 7%. And then the very next year, 1914, it was really easy to erase that percentage and double it to 13.5%. Do you want to take a guess? What was the highest federal income tax rate? Well, I'll tell you what it was. If you made more than $200,000, which in 1944, let's face it, that was like $2 million in our day. But if you made more than $200,000, the Carnegies, the Rockefellers, you were paying 94% every dollar earned over that. Wow, it makes our today highest federal rate of 37% seem very inexpensive. So taxes, believe it or not, folks, people think that they're higher than ever. But in your lifetime, the truth is they've never been lower. So there's really no place for taxes to go but up from where they've been. And they aren't going to just go away, even though we may want them to. When we think about the debt that our country has right now, today, when we think about Social Security, they call it an entitlement program. Even though we have paid into it, they talk about it as an entitlement program. You know, Social Security has been around since 1935. And when Social Security first came to be, there was 64 people putting money into the system for one beneficiary taking money out. Those numbers have completely flip-flopped, and that's because of pure longevity. And the baby boomer generation, Generation X, they are not having children at that rate. In fact, the stats show that there's only 3 people putting money in per one beneficiary. That's a lot different than it was back in 1935. So when we think about the history of our taxes, we think about the longevity risk that we're faced with, and we think about all of the changes. We don't have control over legislative risk. We don't have control over changes in the tax code. It is what it is when it comes time for us to use our qualified money. So we want to make sure that we have a tax-efficient strategy so that we are able to deal with future tax consequences when we're ready to use some of our money. That is our Master Plan Minute. Back to you, Amy.
Up next, if you have questions about retirement, stay tuned. Melissa has answers. Stay with us.
On the surface, your retirement plan might look solid. With your 401k or IRA, Social Security, investments, and insurance coverage, you appear to have it all covered. But what could you be missing? Below the surface, is your retirement exposed to too much risk? It's time for a deeper dive into your portfolio. We can help you uncover the risk that lies beneath the surface and learn about strategies to help preserve your savings. Get your free risk analysis today.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
Time now for your questions about retirement. It is a favorite segment for both of us because I feel like we learned something. I know that we can't always share a lot of details and get into a lot of the particulars, but it gives an opportunity for our viewers to understand how you and your team would answer these questions. You ready?
Fantastic. Looking forward to it.
Okay, let's go. This one is about RMDs. We've been talking about this. This is from Marisol in Green Valley. I know I have to be mindful of taking my RMDs at 72. What retirement accounts are subject to those RMD rules? And already she said 72.
Right.
So see?
And you know this. That's right. Absolutely. Well, Marisol, the accounts that you need to be mindful of taking your RMDs from at age 73 as of this year, so you have another year to prepare for that because the law was just upped again, is anything that falls in that pre-tax bucket. So depending on where you worked, if you had a 401k or a 457 if you were a government worker, 403bs if you were a teacher, depending on where you worked, anything that you have, in this day and age, most people have had more than one career or more than one job. So keeping track of where all of those different pre-tax, pre-qualified accounts are, that way you can make sure that at age 73 this year or next year for you, you are calculating that from one number. Now remember, you don't have to take a little bit from each account if you don't have all of your IRAs together. You can actually just choose an account, and as long as you're taking the amount from one withdrawal, it can suffice for all of your different accounts.
Okay, very good. This is from Dale in Henderson. My wife and I have certainly noticed the big jump in prices lately. We have some goals to remodel a kitchen and put in a pool when we retire. But now we're worried about what prices will be when retirement comes. Do you have a rule of thumb to figure this out so we'll know if we can afford it? And that's so frustrating right now for so many pre-retirees. They have these dreams, these hopes, these goals that they've been plotting out for years probably. This pool, I mean, that's a big one.
Yes.
And all of a sudden, the numbers don't match up.
Dale, my rule of thumb, I'm just going to give you a rule of thumb. If you're planning on doing major construction, like putting in a pool or, revamping your backyard, you may want to do that while you're still working. Dive into taking that expense on now rather than retiring and then having to use your retirement accounts to fund this big project, and then you're going to be taxed in a way that's uncomfortable for you. So for big expenses, try to get as many of those out of the way before you actually retire, if it's close or if it's a possibility, because remember, those retirement accounts are meant to provide you with stable income. There's no retirement without income. You have to have that paycheck coming in on the first of every month. Taking a huge project, and I tell you what, doing a pool is around $100,000. That's a big, steep ticket. And going to the grocery store, having family gatherings. I mean, we all are feeling that. Just buying a piece of lumber, what it used to cost. So it's important. I would say if you have a big project like that on the horizon and you're getting close to retirement, you might want to do a little bit of those projects sooner than later.
Yeah, I feel like we're being the bearer of bad news a little bit, but also sometimes you're giving him, grace to do it now and maybe get started a little sooner. So that's good. Yep. All right. This is from Jacqueline in Green Valley. My husband and I are considering joining a retirement community that has different levels of care as needed. I'm worried about the price. What do you think of communities like that?
Oh, well, Jacqueline, many have firsthand experience with this, and I'm one of those. My parents are actually 91 and 93, and One of the things when we were looking a few years back on the type of nursing home to choose for our parents, we found it really important to find those centers that have the different levels of care. Because when we think about moving, how many times we've moved in our lifetime and how overwhelming it is and how much work it is and how much stuff we have, it's difficult. Imagine being in that very fragile phase of your life and all of a sudden you need extended care, you need more care. And so you have to pick up and take your pictures and move your things. And of course your family's doing all that, but you're out there shopping for a new place for different levels of care. And it usually isn't something that you have a lot of time to make those decisions. It's usually decisions that have to be made rather quickly. So I would say that type of a community is absolutely the best, in my opinion. Of course, you have to be able to pay for that. You have to be able to afford and evaluate the different levels of care. And there's so many different types of long-term care benefit plans that you can actually purchase. There's life insurance that have long-term care benefits as well. So making a plan for that stage of life so it's affordable is very crucial to look at.
Okay, invaluable insight. Okay, this is from Vince in Las Vegas. I'm 54 years old and my employer just offered a Roth 401k option. I'll probably work another 10 to 12 years. Is it worth switching to that from a traditional 401k?
Well, you're 54, so I just want to point out that if you were to do a conversion from your 401k IRA, if your plan allows you to be able to do that, you will need to pay the taxes that you would owe from a savings account. You would not be able to pay it internally, because if you did, you would actually get that 10% penalty because you're under 59 and a half. So your situation is unique. You have to sort of evaluate that. The other thing is, what I would probably suggest would be wiser choice would be to stop contributing to the 401k IRA and start contributing heavily to the Roth component that they're just adding, because you're still going to work a few more years. Just max out the Roth portion and you'll be in pretty good shape. But wait typically till you're 59 and a half to do those conversions.
Okay, great answers. I think we're out of time for our question and answer segment.
Okay.
So very good. If you want to know ways to generate lifetime income, help reduce your tax bill, and maintain your lifestyle in retirement, reach out now to start planning for your ideal retirement. For Melissa Matson of MRS Wealth Advisors, I'm Amy Sharp. Have a great day and an even better retirement.